You're watching Savvy Investing Hub, where smart investors stay one step ahead.
So what if your stock portfolio could pay you like a rental property every month without needing to sell a single share? There's a strategy that can do exactly that, and it's called the wheel. Let me show you how it works. Hey, I'm Mark from the Savvy Investing Hub. We break down time-efficient investing strategies for real people with real jobs, families, and not enough hours in the day to day trade. In this video, I'll walk you through exactly how the wheel strategy works, step by step. And even if you've never traded options before, don't worry. I'll start with the basics. At the end of the video, we'll look at an actual stock and a real-world scenario. Alright, before we jump into the wheel, let's cover the basics of what options actually are, and more importantly, how they work when you're the one selling them. An option is a contract between two parties that gives the buyer of the contract the right, but not the obligation, to buy or sell a stock at a specific price, called the strike price, by a certain expiration date. But when you're selling options, which is what the wheel strategy is all about, you take on the obligation to fulfill that contract if the buyer chooses to exercise it. There are two types of options. There are call options, which give the buyer the right to buy stock from you at the strike price. If you sell a call, you may be required to sell the stock if the buyer exercises their right. There are also put options. These give the buyer the right to sell stock to you at the strike price. If you sell a put, you may be required to buy the stock if the buyer chooses to exercise. So, selling options is about taking on the potential obligation to do what the buyer wants, whether that's buying or selling the stock, if certain conditions are met. And in exchange for taking on that obligation, you get paid up front. That payment is called a premium. That's the key to the wheel. You get paid to take on obligations that you're comfortable with. I know that for many new investors, options can sound intimidating. They're often seen as risky and complicated, but that usually comes from not understanding how they work. Next week, I'm releasing a full explainer video on options basics, and I'll show you that when used correctly, options can actually reduce risk and create consistent income. It's all about using the right strategy, and I'll break it down step by step. Here's the magic of the wheel. It's a repeatable cycle. You pick a stock you wouldn't mind owning, say Ford or Intel for example, and you sell a put option at a price that you'd be happy to buy it at. In return, someone pays you a premium. That's cash in your account up front. If the stock stays above that price, you keep the money and you do it again. If it drops below your strike price, then you're assigned the stock and now you own it at a discount. Now that you own the shares, you sell a call option, again at a price that you'd be happy to sell the stock at. If it stays below that strike price, you get to keep your shares and the premium from selling the call. If it goes above the strike price, well then you sell your shares, again at a profit. Then you go back to step one and you start over again. That's the wheel. Okay, time to look at a real world example. Let's say that you want to run the wheel and you pick Intel as the stock. Stock ticker INTC. Looking at this chart, you can see that Intel has been trading as low as $18 in the last few days. You think $18 is a great price to own Intel at, and you would like to own it if Intel trades down to that level again. Right now, Intel is trading at $18.93. Here in this options trading screen, you can see that there are several strike prices that expire in 28 days. You decide to sell a put with a strike price of $18. And for taking on that obligation, you receive a premium of $1 per share. Since each option contract covers 100 shares, it puts a total of $100 in your account. Now, if Intel stays above $18 by the expiration date, your put would expire worthless. That would mean you get to keep the $100 of premium that you collected, and then you would look for a new opportunity the next month. But if Intel dropped below $18, you would be assigned the stock, which means you would buy 100 shares of Intel at $18 per share. That would cost you $1,800 in total. But remember, you already received $100 in premium, which effectively lowers your cost basis to $17 per share. Let's keep the same chart, although it would look a little different when and if the stock goes down to $18. It'll work for illustration purposes. Now that you own the shares, you would turn around and sell a covered call, say at the $20 strike price. You would get paid another premium. Again, in this example, you would receive $1 per share, or $100 total. And if Intel rises above $20, your shares would get called away. Basically, you would sell at the $20, which would be a profit. That's what's so awesome about the wheel as a strategy. You can get paid on the way into a trade and on the way out of a trade. That's two different income streams on the same stock. So here's how to get started this week. First, pick a stock that you want to own. Look for companies with good volume. I really like this strategy on stocks that pay dividends, but any stock will do, as long as it's a stock that you want to own, and the stock has good volume, and the stock is optionable. I suggest that you use a simulator or a paper trading tool to practice selling a put. No real money yet. Get used to the way that your trading platform displays options. All of them look a little bit different, and sometimes there's a little bit of a learning curve. Track your premiums, watch the stock, and see how it feels. Don't miss next week when I do a deep dive into options. I promise you will understand options after you watch it, even if you've tried before and failed. If this video helped simplify options for you, do me a favor, hit like and subscribe to stay ahead of the curve. Thanks for watching, and remember, stay smart, stay invested, stay time efficient.